All right, we're back. Episode 5. What's up, Vic? How you doing?
Hey, I'm good.
Good to see you. We had a lot of great feedback to the last episode.
Yeah, I'm glad people are listening.
Yeah.
I was like, wow, people.
I didn't know people were listening up until the last episode,
Right,
but yeah,
right.
people are definitely listening. I think we got feedback on both sides, right? Feedback on the, hey, thanks, this was a great, rundown on this, and then also, hey, maybe you were a little too hard
Right.
on Pear Therapeutics, and the folks that were involved. How did you feel about the feedback that we got?
I mean, I think it's an important topic with emotions on both sides, right? Like, I think it's important for people to understand what happened with Pear.
Yep.
Because if we don't learn from the past, we're going to repeat the same mistakes.
Yep.
And I also think that there are really passionate entrepreneurs working on great innovations, and many of them felt like we were somehow attacking them. And I that wasn't my intent. I don't think that was your intent.
No.
But it's hard to build successful healthcare innovations and get them to market, get them reimbursed and paid for. And that is just part and parcel with doing a healthcare startup.
Yeah, I agree. I mean, we ended the show with a quick review. It was pretty quick of A16Z's post on their website around it's time to build in healthcare.
Right.
And I almost think we need to kind of pick up there because we didn't really make that in the title of the show. Yeah. It wasn't something, we promoted a lot.
There's so much focus and attention and research around Pear, and then we just threw that in there.
Sure. And I think they were related, but maybe we didn't, fully express why we took the time to review that, like literally line for line, calling out specific aspects of it. And I think for me, I just think that what we're doing in healthcare venture capital, what the founders are doing who are trying to build innovative healthcare companies, it's serious business, especially when you compare it to like a digital marketing, social networking, e-commerce-y kind of business.
The examples, I mean, what triggered me is examples that A16 gave as success stories that could be replicated in the healthcare setting did not resonate with me as the same, right? So
at all.
Lyft, Airbnb those aren't the same kind of markets.
No, and they were very, we spent a lot of time talking about the impact of the regulatory environment on the entire class of innovation that is digital therapeutics, right? Like, we were directly connecting the actions of a little bit the FDA, but more CMS.
Right.
And the results of what happened to that company, right?
Yeah.
And to just sort of say that the hotel industry or, the taxi industry are highly regulated in the same way it's not even an understatement. It's just not true. It's just
it's misleading is what I think.
It's just not true. And I think that was, there were a couple of key things we were trying to point out in the Pear breakdown. One of the key things was the importance of having a clear path in the regulatory environment to produce innovation that actually can become viable. If you don't have that, you don't have a real shot. I mean, that's the unfortunate truth. And it's really, really important for venture investors to understand that, whether you be like a fund manager or you're an LP, who's in a fund and you're trying to figure out whether or not your fund manager knows what they're doing.
Yeah. Or you're an angel founder investor trying to build something.
Yeah, yes, exactly. Like, you need to understand that there's a time and a place for pushing the boundaries of what's going on in the regulatory environment. Spending significant amounts of venture capital, probably not the right place for that.
Yeah. I mean, I think the difference to me as I was thinking about it over the last 7 days is the infrastructure in the federal government to regulate healthcare is stronger because they also are buying either directly or indirectly. They're paying for half of healthcare.
Right.
Where in hotels or taxi cabs or other markets that are regulated, they are the referee, but they're not the buyer. They're not spending the kind of money that they spend in healthcare. And that's just a different thing. They have a lot more market power because they're such a big buyer, basically half the spend.
And they set the price.
That all the other buyers look to them.
Yes.
And yes, they set the reference price, and then you price your
against that. Yeah,
right.
But they set the fundamental price that we all use as reference. So,
and I think it's important just to go back to payer quickly. I mean, it is true that digital therapeutics offer a lot of promise. But it's also true that payer was the celebrated poster child for how this was going to be change the whole landscape.
Because of their financial results, not because of their clinical results.
Because of their financial results, because of the strategic partners they assembled that we went through last week.
Yep.
And what was disappointing is that when they SPAC'd and took it public, all of those credibility stamps, all those strategic partners sold. And I am sorry, but I think that is challenging for the digital therapeutics market right now.
I agree. And we don't need to harp too much on payer. I mean, today, as we're recording this, Elizabeth Holmes is...
she's going to jail today.
And that's yet another case, right, where a promising set of technologies is going to have a black eye for a very, very long time.
Yes.
Right? Because of and what's so incredible, especially like being in healthcare as a VC, what's so incredible is that she's going to jail for defrauding investors. She's not going to jail for any harm done to patients.
Right.
That part is just...
I wasn't paying attention to it, but I think that probably was the easier thing to prove.
Yes.
And the DA, whatever, wanted to see her go to jail. And the reality is that if you're going to innovate and bring new technology to market in healthcare, people's life is at stake. And it's just not the same as a ride home after dinner.
No.
And it was frustrating that A16Z sort of pretended that they knew healthcare totally, because we've been in this for a long time, and I'm learning. The reason we're doing this podcast is it allows us to sort of dive in and learn things, and it has to be taken seriously, and that provides huge opportunity to impact the world, impact people's lives. It's why I'm in healthcare venture. I think it's why you're in healthcare venture. It's important stuff. And part of that is it's regulated.
That's right.
Digital therapeutics and blood testing, all of these things that came out on the wrong end of the regulations, unfortunately, set us all back because people didn't follow the rules correctly. And that just is. I mean, people can be mad about us saying it, but it just is. It is what it is, kind of.
Yeah, and we did. We had some good exchanges afterwards with some listeners, and one of the points made in those conversations was that we could have pointed out that there were many other SPACs, that companies that were going out via SPAC. I thought that we did highlight that, but the Wall Street Journal's done us a favor here.
Right.
On May 30th.
They obviously were listening.
You're right. Company insiders made billions before SPAC bust. So everyone, we're saying the quiet part out loud, right? I mean, this is not the kind of PR you want, having a picture here of, Chamath and Richard Branson at the Virgin Galactic, SPAC. I mean, yikes. But just look, the sub headline. I mean, I think that's worse than the PPE thing. I mean, executives and early investors sold shares worth $22 billion. I mean,
in financial markets, there's always going to be people that take advantage of a market opportunity for their own personal financial gain. That's just part of the financial markets. I don't love it, but it kind of is. You can't have Wall Street without having that potential.
And this is why in publicly traded markets we have regulation. This is exactly why, right? Because this behavior, the incentives for this behavior are always there, and there's always going to be this kind of behavior. It's just we're not getting out of that.
Right. Yeah. So yes, there were, I don't know how many, a lot of SPACs beside Pear.
Yep.
Pear was the one that I think you and I believed would be illustrative to entrepreneurs that are building today.
Yeah.
And Theranos certainly is too. I think that's been pretty broadly covered where Pear had not been covered.
Right. Agree. So let's continue on because we've got some more articles here from the Wall Street Journal that are relevant to us.
Yeah. I mean, these are in the last couple of weeks.
Yeah. May 16th, an article about venture fund performance. This is not healthcare specific. This is the broad asset class category. And the headline, venture fund returns show worst slump in more than a decade. And if you're able to see the graph, you're watching this on YouTube, which by the way, if you're listening, we also do this on YouTube. We're video recording, and every time we reference something, you can sort of see it on the screen.
One of the comments last week, we should try to illustrate it with words more because a couple people were listening. And
okay, let's try to do this. Basically, in 2021, money go up, and in 2022, money go down. That's the
and just for a frame of reference, I mean, some of the returns were 60, 70, approaching, the top of the graph is 80%, didn't quite get there. And then it goes negative.
Yeah.
For the first time, I think the first time in my career. I haven't gone back to every 12-month quarterly return, but it's not negative that often.
Yeah. So that's the environment we're operating in as venture investors right now.
And that's what founders have to deal with because it just flows down. Like we are under pressure to find the highest potential, best deals. And that just automatically puts pressure on all the founders.
Yeah. This is an ongoing thing. I mean, I'm noticing just as a general trend in conversations that founders are just not spending that much time. And I kind of get it. I remember being a founder. Founders are not spending that much time focusing on what VCs are actually dealing with. And so when they get bad news from a VC, they're kind of looking at it in isolation as just this VC is, being mean or bad or unfair to me, like totally missing this context.
Right.
Negative returns. Like the markdowns are so severe that we're in negative territory right now.
Yeah. I think
this is a threat. This is a threat to the entire profession.
Yeah. Right. And so if half of the VCs out there fail, which I think is likely to happen, there's going to be a lot fewer people writing checks, sort of obviously, right? And I understand. I mean, it is really frustrating to raise money 2 years ago, hit all of your operating metrics, do everything that you told the investors at the time you would achieve, come back to market for your next round as expected because you raised 2 years of cash to get you to the next kind of threshold.
Yep.
And then hit this market environment. And I don't like it either. I mean, I wish it wasn't like this, but we have to sort of help entrepreneurs understand the market realities that we're all under.
Yeah. So while that is true.
But we have good news too.
Yeah. Well, it's mixed news actually, right? So then this article came out on May 25th. Again, Wall Street Journal, headline, venture fundraising in healthcare rises as investment in startups slows. So, and then I'll actually read the subheader.
Yeah.
Looking past recent negative returns, so acknowledging we're in a slump.
Their article.
Acknowledging. VCs bet that biomedical innovation coupled with declining startup valuations will one day yield fat profits. So basically, down rounds, getting great innovations on the cheap in the healthcare space, which is a space that investors like A16Z feel like is the untapped potential landscape for venture.
Yeah, And I mean, it is. It's why we're in it. It's a huge opportunity. And also, it's complex because people's life is at stake and it's very regulated. And if you don't have approval from the FDA and reimbursement from CMS, it's really challenging to get your product to market because you can't get reimbursed.
Right. So our friend Emily Evans, who leads health policy at Hedgeye, who we had on the show, I think episode 2, she came on, and we talk to her every week. So she's a big part of how we stay smart on the policy side, specifically on the policy side. She sent out a note on Sunday, and I think we both talked on Monday that we didn't even understand what the note was. Right. So we had to have a late night conversation.
Her translation of policy, I couldn't understand the translation.
Right. And that's how Byzantine health policy is, especially when you start to blend in economics, which is what she did here, right? Yes. You start to look at the economic aspects of it.
Yeah, but we're going to try to translate it for the audience because you have to understand it. Yeah,
I think we can, right? So she came out with this note, and the headline, she once a week, again, I'm going to go ahead and plug, it's not that expensive. Yeah. This product, Health Policy Pro with Hedgeye, if you want to get really, really smart, you should sign up for this. Okay.
Yes.
Chart of the day, PCE plus healthcare, it's the price is stupid. So she's focusing on the core metric that the Fed uses to look at inflation. We talk a lot about CPI, right? There's a lot of talk about the CPI print.
Yeah, but that's what people know about mostly. But that's not what the Fed follows.
Yeah, what they are actually looking at is PCE, which is personal consumption expenditure, which is basically what are households spending, right? On a monthly and annual basis. What are they actually spending?
And I think it's well publicized. They're going to keep rates high until that comes down.
Right. So we're reading this, and she had this graph in here that basically has a bunch of bars. It's a bar graph, and then there's a line against it. And this is kind of a Hedgeye thing, is to take two different data sets that you wouldn't necessarily always look at together, combine them so you can see a correlation and a relationship there and understand what that relationship means. So in this chart, the line that's going from left to right, that is reflective of the PCE Index, which is a measurement of the price of things. So not the price and the volume that equals one big number that the household is spending, but actually an index of the actual price of something.
Yeah.
And then the rest of the bar is just the total amount that's being spent, the total spend, which is a function of both price and volume, right?
Yes. And there's a lot of data here that makes it, there's a lot to sift through, which is why I had trouble understanding.
Yeah, there's a lot. So for those listeners who are not looking at this, the healthcare PCE index increased 2.9% year over year. Okay. It was 3.3% year over year at hospitals in April. All right. So we're seeing that the price is going, she's trying to make the point that the price of
healthcare is going up.
Correct. So we spoke to her, and then she gave us an even better, more clear chart about how impactful this really is.
With the time frame we actually care about.
She tightened up the time frame from the beginning of 2020 to where we are today, April of 23, because we don't, we're wrapping up May today. And what you can see on this chart is that the line, which represents the index, which represents price, is way outstripping the volume. And as Emily explained it to us, when you overlay the index with the total expenditures, what you want to generally see to know that price is, kind of being maintained at a clip that makes sense for inflation, is that the line is basically close to in parallel with the top of the bar graph, right?
Yeah.
And for those who are listening but not watching, this line, the index line, breaks out at around May of 2022 and is now pulling away considerably.
Right.
Pulling away considerably. So what that means is that the actual price has become more of a function of the total cost in terms of what we're spending as households on healthcare than the volume.
Right. So I think that the government, people in government are looking to control both price and utilization. And they move the levers back and forth for a long time, starting with the Affordable Care Act, or even maybe a little before that. Government has been trying to figure out how can we reduce the utilization. People are getting a lot of healthcare procedures, a lot of healthcare services, and that was believed to be driving the total spend. And I think what the point of this is that has shifted now. And the volume, the utilization, how much services we all are buying is not growing very quickly. And the price is the real driver, is the real concern.
Right. So then, we asked her for some source data on this. She pointed us to the actual BEA site. So the actual government site.
It collects all this information.
Yep. So BEA.gov is where you can find all this stuff. And this was a news release that they pushed out on May 26th, talking about the personal consumption expenditures. In April, it rose about 40 basis points. Okay, but then when you scroll down to actually read the details on it, it says that the increase was largely driven by financial services and insurance, healthcare, and other, which is notably professional and other services. So again, labor prices being durable, going up, the cost of labor going up is driving up personal household expenditures.
Yeah, so I think we switched to the overall economy here.
Yeah, we did.
And so this is literally what the Fed looks at to decide, are they going to raise rates, keep rates the same, or drop them? And it is stubbornly high. It continues to increase. And healthcare is one of a very few of the real drivers of this.
We've been talking about the durable nature.
Which is not surprising.
We've been talking about the durable nature of the cost of labor for 5 straight episodes. We're going to continue to talk about it because, quite frankly, it's the thing we have to solve for in healthcare. It's driving the price increases, right? And I think we're about to move into an area that really proves healthcare is a different kind of industry, right? So we have these price increases, but what makes it particularly challenging in healthcare is we don't have price transparency.
Yes.
Even after a bill was passed in the Trump administration, that didn't work.
Right. 6 to 8 years ago.
Yeah.
The Trump administration with some friends in Nashville that we know decided the best way to affect change in healthcare would be to show all the prices of everything. Because, of course, they were Republicans and free market people, and they thought, if we show this, the market dynamic will make a difference.
And by the way, yes, Republicans, yes, free market, but also, households pay for this at the end of the day. So it is slightly weird in America, a system, based on capitalism, that we do not understand the prices on things. And that they're secretly negotiated between large healthcare entities. I just want to say, looking at the healthcare industry versus every other industry that actually flows down to household spending, this is, regardless of how you feel about it, you have to acknowledge it's different than pretty much everything else that we pay for.
It's different and terrible.
Yeah.
I was a seed investor in a thing called Change Healthcare. Yeah, I think it was in 2007, 2008. That set out to try to bring this out into the open. And it was somewhat successful. We sold it, and then it got acquired, and the mission shifted, and they don't do that anymore. And I believe that's because it was not something that the big players really wanted out there. And I think it passed, right? So the bill passed, Trump signed it. It is a law. And of course, Biden came in. He has not overturned it. And yet the health systems and the payers are doing their best to avoid it and not really not really live up to the spirit of the law. I don't. There's a lot of technicalities in it, but
in all practical terms, it's had no impact.
Yes,
that's. I think that's the important part, right?
No one knows. I mean, people go to the hospital and have services done, and you get a bill 30, 60, 90 days later, and it's over. You don't have any ability to make a decision. That's not true in any other purchase decision in America. That's un-American. That doesn't make sense.
I can't think of any other thing that I spend money on where that's the case.
Yes.
Nothing.
That's right.
So anyway, just need to point that out as like one of the clearest differences in our industry when it comes to innovation, right? So Emily always, hawking all the bills that are working. She pointed out this act that's currently in the House. I think it's in its second drafting right now. The Patient Act of 2023, and it's a new Price Transparency Act. And it's being driven by this understanding that the price of healthcare is literally pushing up household expenditures and keeping inflation high.
Right. And so all of us that want the Fed to relent and stop raising rates and let us come back to a more traditional rate, that won't happen until we start to get some modulation in price, at least in healthcare. And so Congress is attempting again to now basically close some of the loopholes, write another bill that will do the same thing, mandate price transparency. You can charge anything you want, but you have to publish it openly, and hopefully it will work this time.
Yeah. So for anyone who wants to Google this, HR 3561 is the bill that's currently being worked on. And it's called the Patient Act of 2023, which stands for Promoting Access to Treatments and Increasing Extremely Needed Transparency.
Yeah. And it's, it's in committee.
Yeah.
But and of course it's in the House, so the Republicans are driving it. But I think it has reasonable bipartisan support because everyone wants the prices. Democrats and Republicans don't want their constituents getting bills that they don't even know what it is.
Right. All right. So let's stop here. Let's take a break and play a quick ad, and then we'll circle back to talk about how this price issue, this cost issue, is actually creating real challenges that are opportunities for us as healthcare innovators to take on.
I want to take a minute to talk about our investment vehicle, Jumpstart Foundry. It is the product that Marcus and I put together first. It invests in pre-seed companies at huge scale, 30, 40, 50 assets a year. Every year, Jumpstart Foundry invests in across the U.S. the best and brightest entrepreneurs that are really making a difference, making something better in healthcare. If you listen to this podcast, you hear all the challenges, everything we're facing in healthcare. Bottom line is we spend $4 trillion a year and we don't get great outcomes. Jumpstart Foundry allows individuals for a very small minimum, $25K, you can come in and get to deploy that capital across the entire portfolio. You get immediate diversification. There are no management fees, super easy to get involved and really make a difference. You can have an impact. Come learn more at www.jsf.co. That's Jumpstart Foundry. Thanks for listening. Now back to the show.
All right, we're back. So we left off talking about HR 3561, the Patient Act, and really that was to wrap up an entire segment talking about price. Now we want to shift to a place where price isn't just affecting households, but it's affecting really large, important institutions. And I think we wanted to make this, we wanted to cover this because we wanted to ground everybody going through it. I think it grounded you and I, Vic, right? As we started to really dig through it and how important the work is that we are trying to do and why we have to take this seriously and why we have to understand all of the aspects, as many as we can, all the aspects of the problems, because many, 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 many lives are currently at risk because our institutions are challenged in an unprecedented way. Like very important institutions are challenged in some unprecedented ways.
Yeah. And at least for me, I see the headlines and I almost get numb to them. Like, okay, another headline, another headline, another headline. But I think it's part of what I like about this show. It's what I wanted to do, to find one and dig into it, to really try to understand more of the reality.
Yep.
And
so for this one, we picked CommonSpirit. So CommonSpirit recently released their unaudited quarterly report. I think a lot of people may not know that as a nonprofit, you may not think you can get access to their financials, but you can. They do share this information, so the journalists don't have scoops. I mean, the financial report is available.
Yeah. Well, I mean, if you have debt outstanding, especially bonds or publicly traded debt, you're mandated to put it out in that case.
Yeah. And CommonSpirit certainly, not just because of the debt and the bonds, but really it's the scale of the organization. Yeah. You'll be able to they'll always have some, reason to comply and produce these reports.
It's not the same attention and pressure as a publicly traded, earnings per share.
That's right.
Platform, but they do disclose a lot of information.
That's right. So we're talking about CommonSpirit Health. CommonSpirit is the largest nonprofit health system in America.
Yeah.
We're going to quickly just talk about how big they actually are. So they have over 1,000 care sites in 21 states, serving 20 million patients.
Yeah, they are huge, and that makes them really important to dig into.
Yeah. And again, 20 million patients. Want to kind of really focus on that, right? When we're talking about them, we're not talking about some stock. We're talking about an organization that is caring for 20 million patients. That's the thing we want to anchor everybody in.
Yeah,
as we start to roll through this situation.
Because we're VCs and we have friends in for-profit hospital systems, health systems, we talk a lot about for-profit health systems, but the majority of patients and the majority of health systems are nonprofit.
That's right.
And CommonSpirit is the largest of that.
Yeah. So they are not, I think we should say this on the front end, as we start to unpack some of, these results from this financial report. This is not representative of the entire, segment of nonprofit health systems. They have some things we're going to dig into that are unique to them, but in general, nonprofits do have, a bit of a different mandate than the for-profits do. And they have a little bit less optionality. We're going to dig into that as well in terms of who they care for. And so that's why I think it's particularly important as healthcare innovators that we don't just say, hey, let's only focus on the for-profits that are in these wonderful markets with this, these great payer contracts, generating these great returns. Like, if we really care about healthcare in America, we have to pay attention to this.
Yeah, no question about that.
Okay, so I think we're going to start by just going right to the headline. So this is in page 7 of the report. And Vic, what are we looking at here?
I mean, the basic headline is they lost a little over $500 million in the quarter. So, like, from a operating loss point of view, it's a sort of they actually lost 658. But they adjusted it for a bunch of things that they think are non-recurring, et cetera.
Right.
And so somewhere between 500 million and 650 in the quarter, they lost.
Right. And this is not the first quarter that they've recorded this kind of loss. Last year, CommonSpirit, I think, in total lost $2 billion.
Yeah. Which, so they're basically on track for the same.
Yeah. Based on this quarter, which is Q3 of this fiscal year, which will end in June of this year. So obviously, no organization wants to be producing these kind of results, right? This is really, really tough. We know all health systems had a very, very tough time coming out of COVID. There was a need for significant stimulus. But again, just going back to that price, right? To that price that's really being driven by the cost of labor. This is a really, really durable issue for health systems, this labor issue. Now, I want to skip down to their liquidity section just because they make a clear statement around what, I've kind of, as I read the report, I said, these are the four horsemen they're really sort of dealing with.
They're very honest about what,
They're transparent. It's actually very helpful. If you want to be, in the business of trying to help health systems, this is a good thing to read, right? So you can actually understand what's going on there. So when you're talking to, contacts in the organization, you can be reasonably well prepared and, and thoughtful in what you say.
Yeah.
So this, the liquidity section, they've gone down in their overall base. They were at $16.2 billion at the end of June of 2022. At the end of March of 2023, their unrestricted cash and investments were at $15 billion. So that's obviously a decrease of $1.2 billion in nine months of the fiscal year. And at the end, and that's always an area, liquidity is critical, right, for any organization. So,
especially when you're generating losses.
Right. So we're obviously going to focus on this and sort of look at this. And the last sentence of this paragraph, I'm just going to read in its entirety because I think it really talks about what the core issues are that the organization is dealing with and that I think many nonprofit health systems are also dealing with.
Well, let's just mention the days cash on hand because that's the number one thing that I look at that I think a lot of debt holders look at.
Yep, that's fair. Yep.
Which is they have 161 days of cash on hand right now.
Yep.
Or at least when they publish this.
Yeah.
So that's down from 176, which is not good. That's a
not a good trend.
Yes.
Not a good trend.
Yeah. So when you read the next line, they have to turn that around.
Right. So this sentence, that's again, it's in the liquidity section. It's the last sentence of the paragraph. CommonSpirit is actively monitoring liquidity given the operational disruption related to inflationary pressures, payer mix shifts, continued concerns of a looming recession. I thought that was a really interesting one. And the impact of the cybersecurity incident on receivables. So we should just quickly note they had a significant cybersecurity incident. You can read about it. They detail it quite well in the in this financial report. And this, again, is an issue that many, many, many healthcare organizations, especially health systems, because of the EMR data that they have to be stewards of, which interestingly, everyone talks about how that's an asset. But I think when you think about the cybersecurity risk, it's quite frankly a liability that they have to house this data. So obviously, anytime you have a cybersecurity thing, you have a ransom, you have to pay out to the ransom. That's very unfortunate. It's not something you can necessarily predict when and how much it's going to cost, et cetera. But it's a real issue. But sticking with the top three ones that are more macro, less acute, inflationary pressures. That means labor.
Yeah. And it's hard to see, A, how they can control that, or B, how it's going to get less challenging.
Right. The second one, payer mix shifts. And we're going to spend some time talking about CommonSpirit's payer mix, because I think once you and I dug into that just completely changed the way we were even thinking about them as an organization.
Yes,
right?
That's right. And let's put a pin in that and come back to it.
Yeah. And then this third one is continued concerns of a looming recession.
Yeah, that one kind of confuses me. I mean, I agree. I think we're in a recession now. I think there's a looming recession it's gonna be worse than now. I'm not sure how that affects their liquidity.
It's interesting, right? I mean, it could, but they don't explain it. But if we had to sort of just throw some things on the wall, one thing you might point to could be the continuing banking crisis, because, when you're in this kind of situation, having, the financial ecosystem, having credit collapsing is not great. Is right. Right. Because that removes some optionality that you might have. And then another issue might be continued contraction of commercial payers and the payer mix. If employment decreases in some of their markets or something like that.
That I can imagine someone thinking that. I don't think that's what the data actually shows. I think
people use more healthcare.
People use healthcare when there's a recession, and if they're worried about losing their job, they actually, I think, use more healthcare.
Yeah,
but it's, if the CFO is looking for things to throw in, it might make sense to throw in. There's definitely going to be a recession.
Yeah, so. Or maybe they're just smarter than us about this because they run this thing, and we're all speculating.
Fair. So and we should say we don't have any direct connections.
Zero.
At least I have no connections.
I don't either. Right. Zero.
No. So we are spending time digging into this, but we have no insight other than what's publicly available.
Yeah, we're spending time digging into it because it's the largest nonprofit health system
and we
in
want
America.
Be smart investors.
Yeah. And certainly portfolio companies we have are trying to sell in and all this other kind of stuff, right? Yes. So, okay. So now let's shift and look at CommonSpirit's footprint. So we already said it's in 20 different states. If you're looking at this on YouTube, you can see complete coverage of the West Coast from Washington all the way down to the Southwest Texas. They fill in some of the Midwest coming up through the Northern Midwest, North Dakota, Minnesota, Wisconsin, and Iowa. And then they actually have reasonable coverage in the Southeast and sort of the Midwest that is above the Southeast.
Yeah.
So they're in a lot of states.
Yeah, they cover a lot of Americans.
Yes.
Across the country. They're not in the most lucrative market, which is Florida.
Yes.
But Florida is well healthcared. There's
Yes.
plenty of healthcare services in healthcare.
Yeah.
They're in some markets that they're needed.
Yep.
Right. So it's interesting thinking about a nonprofit, which earlier I think is mission driven, and then they have to figure out how to run the finances.
Right.
A for-profit would flip those and we are trying to build shareholder value and we want to deliver on the mission.
Yeah. But let's be really clear. The financial performance of CommonSpirit over last year, extending into this third quarter of their fiscal year, if this was on the public markets, I mean,
it'd be killed.
This would be killed, right?
And no for-profit is performing like this. Maybe not. No, none at this scale.
None at this scale. And look,
I'm sure there's someone.
I mean, HCA just had a fantastic Q1 from a financial perspective, right? Fantastic. So really, really broad coverage in a lot of markets, a lot of middle America, quite frankly.
Right.
A lot, the West Coast, yes. But besides that, it's a lot of middle America.
Yeah.
It's a lot of middle America. So now we're going to go to the payer mix.
Right. This was the most insightful thing for me.
Yeah. And I love the fact that they cover year over year, Q3 to Q3.
They're very transparent.
It's great. It's great.
Right.
So the first thing you see is the majority of their payer mix is in Medicare. Okay. So this year it's more than 45%. Last year it was less than 45%. So they've increased their Medicare share year over year. Then they have the next category is commercial. So they're somewhere in the 26%.
Right.
Of their payer mix is commercial. That is down from last year, where maybe it was 27% last year. Okay. Medicaid, pretty flat, at about 21.5%. Okay. And then the rest is self-pay and other. So the important thing here is when you combine Medicare and Medicaid, that is over 65%. It's probably near 67% of their payer mix.
Yeah. And I almost fell out of my chair when I saw that. That is the number one predictor of a individual hospital or a health system's financial health and success, is how low that is and how high the commercial book is. I don't study this all the time, but I've never seen it this high. Yeah, I mean, it is challenging to run a health system at 65% Medicare Medicaid.
Very challenging. And the trend is that their Medicare Medicaid, specifically Medicare, is increasing.
And commercials decreasing.
So, look, after seeing this, that was when I was like, okay, if 65% of the payer mix is directly coming from CMS, it's Medicare and Medicaid, this thing, it's not just a nonprofit. It's getting really close to being a national utility. I mean,
yes.
this, we typically think about safety net hospitals as like community hospitals. They're just in like a city or a rural town or something like that. This is just by payer mix. I'm not saying this in any other way, but just by payer mix, this is almost that at scale. Like they are taking care of our senior citizens and our most vulnerable populations in 20 states at a 2-to-1 level that they're taking care of everyone else.
Yeah, so it is 20 million patients, so 12 to 13 million are on Medicare or Medicaid. So they're elderly and paid in and earn the right to have
retired.
Yeah, right.
Yeah.
Or they are very vulnerable, really low income, or have really challenging health care, and that's our society says we should take care of them. The basic recipe would be you should not do as much Medicare or Medicaid and increase the commercial book, but that would probably would be hard on their mission. So like it's one thing for me as a VC in Nashville to say like just fix this, but there are 12, 13 million people.
That's the point.
That have to be taken care of by somebody.
That's the point, right?
And so whether it is CommonSpirit or they continue to struggle and days cash goes down and down and down and they can no longer be the same entity, those people still need care. And so it really changed my perspective because of the scale of CommonSpirit.
Right.
And this mix that is crazy big, but it also, you're right, it makes them, I mean, I don't know they're too big to fail, but someone has to take care of those people.
Yeah. And so I actually want to kind of just quickly go to Ascension's payer mix, courtesy again of Emily and the team at Hedgeye, because like we asked her, we're like, okay, can you give us Ascension's just so we can see like, is this kind of what it is? And she presented us with this graph, and no, Ascension has, in terms of their commercial and other managed care part of their book,
it's 50-50.
Yeah, it's 50-50.
Roughly 50-50.
Yeah, it's 50-50. Their Medicare and their Medicaid taps out, at around 50%.
Yeah.
Not 65, not 67%.
Right. Because 67% doesn't work. And Ascension is a nonprofit. I mean, this is not like a super aggressive for-profit. This is the other, there's several big nonprofits, but this is probably the other biggest.
It's the second biggest. I think it's second biggest. Yeah. So anyway, I just wanted to put this out just to say, don't read what we just showed in terms of the payer mix of CommonSpirit as like, that's what all the nonprofits are doing. No. We're actually going to talk about CommonSpirit, right? Like this organization has a payer mix and clearly, but in terms of their acquisition and their design and the markets that it's clearly in their mission 2-to-1. They're going to take care of the elderly and the vulnerable.
Yeah. So I started thinking about what could entrepreneurs do?
Yep.
What could we invest in? How could we bring things that would help? And I think we should talk through that. CommonSpirit is huge.
So that's a challenge. Just scale. Anytime you're trying to be in innovation space, we're startup, we're seed investors. You're talking about trying to bring something to an organization of that scale. It's difficult.
Yeah,
it's
just
hard.
as a thought experiment, what could we do?
Yeah. Okay.
And then I also think that every health system is different, but there's a lot of regional nonprofits that sound a lot like CommonSpirit.
Yep.
They might be in between Ascension and CommonSpirit, but they are in a geographical region that is constrained, right? They have the people they have, and they are only in one city or one state, or maybe they've expanded into second state. And there are lots of health systems that are struggling with a version of what CommonSpirit's doing. And so I think it's useful, even if we're going to sell to if we're an entrepreneur in one particular city, you almost certainly have a nonprofit health system there. And CommonSpirit is very transparent, as we've said a couple of times. And if you can solve for them, it's pretty likely that the health system that you can drive to will have similar things. Maybe not quite to this extent, but that makes it a really interesting thought experiment as a venture capitalist or as an investor in innovations. That our basic audience is operators, investors, and founders. And any of those need to think through, what would we do if we were in their seat?
Yeah. And so we were thinking about it, and then you went and you actually looked up, well, what are they actually saying?
Yeah.
Because they released these results, and there's lots of articles about the losses. It's an easy headline, right? It's an easy money headline. But then you found an actual interview with the president and COO on Becker's Hospital Review.
Yeah.
So Marvin O'Quinn, and he was talking about sort of what CommonSpirit needed to do, given the situation that it's in.
Yeah. And people should read it on Becker's. We can link to it in the show notes. But he was very transparent about the challenges and leads with the mission that they're trying to fulfill. And it's a written article, so it's difficult you can't ask questions or get much information. But the quote that we have on the screen here that I thought was the most important is, there's lots of tactical things. There are some strategic things. I have ideas. You have ideas. There's lots of things we could think about introducing. But I thought it was really telling and powerful that Marvin is talking about, you've got to create a culture that's different than the culture we've had historically. And this culture involves being comfortable with and embracing technology, along with becoming a technically advanced organization where people constantly enhance their skills. Such a culture will attract clinicians and staff who want to be part of an organization on the cutting edge of technology. And so, yes,
Right.
I agree.
That's exactly what I want to hear the COO of CommonSpirit say.
That's exactly
in a situation like this.
And it's future tense.
You've got to create a culture.
Like, he is talking about what they are going to try to do before they run out of financial flexibility and can no longer do it. And who knows what that time frame is? I mean, it is, as you said, it's a really important part of the U.S. healthcare delivery network, and they're pretty big. And they seem to be, I don't know, Marvin, but seem to be pretty well run. And it's hard to change culture. I don't know what the time horizon is that they have, but it's a lot of work to change the culture of that size organization. And
you're not just talking about changing a culture, but let's just to revisit the quote. Again, this is his quote. This culture involves being comfortable with and embracing technology. Now, you wouldn't have to call that out if it wasn't,
unless you aren't.
If it wasn't a fundamental part of the challenge. And we've talked in the past, we talked about it in the last episode, about how, unfortunately, the HITECH Act and the way that EMRs rolled out have done us no favors in terms of making the healthcare ecosystem excited about new technology. It's not. Like, they're not excited about new technology.
They're not excited. And I think that challenge presents an opportunity for founders and for investors. Like, of course, they don't like the EMR. EMRs suck. They're not very good. They take a lot of time. It's way too many clicks and typing and keying in things. And so there's an opportunity for entrepreneurs and for VCs to really understand, what do the workers need? What do they need to make their job easier? And the best products are ones where you pick up your iPhone and you know how it works. I mean, you don't have to study and go to a class. It's just intuitive. Of course, I want to use it. It helps me do the things I want to do. Unfortunately, technology so far hasn't met that standard. And so I think CommonSpirit wants to shift their culture. They're going to try to teach people to be comfortable. It will be a lot easier to do that if we create some products that really give an incredible benefit to people and are easy to learn.
And that might be where we circle back to the A16Z letter.
Yes.
After everything we just said, tech people, this is actually what we need.
Yes.
Right?
Talk to Marvin. Talk to anyone at your healthcare system.
Yeah, and build beautiful, helpful, easy to understand, time-saving, cost-saving technologies to support an institution across 20 states serving 20 million patients, 2/3 of which are being paid for by Medicare and Medicaid.
By our tax dollars.
In a culture that is skeptical about technology.
Right. With leadership saying you have to figure it out to their people.
Yes.
And we talked about this before, but I'm going to say it again. This is how we have built products in other markets. But it has to be with the people in the health systems, people that are doing the work, the people that are in a CommonSpirit location. And it's Steve Blank. You need to sit with the nurse or sit with the doctor or the intake person who is making you fill the stupid clipboard for the 100th time. And instead of insulting them and telling them how terrible it is, sit with them for half a day and try to build empathy for what they're dealing with and then solve their problems. And that is what can work in healthcare.
And don't worry about trying to create the next Google.
Yeah. I mean,
that's not what we need right now.
No. And the value chains are super intertwined. You cannot just pluck something out and then act like it doesn't interface with the healthcare system.
That's right.
That's not real. And so what I get frustrated with A16Z about, I love that they're bringing attention to it, but they were too cavalier about, we know how this is. We read one blog about it and we got it now. And we're going to just come back and build everything in Silicon Valley and then present it to the healthcare system to use. And I just don't think that's real.
Yeah. So
anyway, I had lots of ideas and then I read Marvin's comments and he is on it. Now, he's on the most important part. Okay. Yeah. Like anyone who knows me outside of all this healthcare stuff, leadership is about creating a culture in which a business can thrive. There's literally the only job that leaders absolutely have. You have to create a culture in which the business can thrive. So the fact that this is what he's saying, this is the most important part, because if you don't create this culture, we can create as much innovation on the outside as possible. Yeah, it won't be received correctly. Right. And
period.
And he obviously knew the report would come out on the 15th. He did the interview 3 days later. And I take it as a hopeful sign. Now, there's a lot of execution. There's a lot of work to do in getting from this challenge, which is immense, to solving one problem and then another problem. But it seems like there's a leadership team that is at least interested in making improvements.
Yep. All right. That was a lot. Even my head is hurting after this show because we covered personal consumption expenditures. We covered Elizabeth Holmes. We covered SPACs, we covered CommonSpirit, we covered payer mix. We covered a lot, but I think the point here is that this industry is already very Byzantine. It's already very difficult to understand. But just like every other market, it's dynamic, and we have to keep up with it. I mean, the reason why we're doing this show this way is because every week there's something new that we have to try to unpack, right? And our job as healthcare investors, like our literal job, our obligation to our LPs, like we have
the people that pay us.
Yeah, the people that pay us. Our purpose is to try to do our job well, such that the innovations that we bring into the market will improve health for all. That's our North Star. But we have limited partners that we have to produce for, and we need to make sure we're placing capital in companies that have a shot to be, there's never a guarantee in venture, but that have a shot at being successful. And studying all these things, not just historically, but in the present time, this is critical work. So, one of the reasons why we wanted to do this show is because we looked around and we realized there were no other VCs doing this show, period, in the healthcare space. And a lot of founders who want to be healthcare founders, but maybe don't have a lot of experience in the healthcare industry, if we don't do this, they're going to be listening to All In, or they're going to be listening to, I don't know, like pick a show that does not
A16 bio.
Yeah, that does not properly frame the difficulty in this market. It's a worthy thing to do, to start a company in this industry, but you got to understand the fundamental challenges we're all up against.
I mean, important things are hard.
Yes.
Right? I mean, they just are. If they weren't hard, they would have already been done. And so, I mean, it's my career the last 23 years, and I'm planning to do it another 23 years. And we didn't pick healthcare because it was like low-hanging fruit, easy. We did it because it's a huge market. It affects millions of people's lives. It affects our parents, our children, people in our community, us. And if we don't do it, who's going to? And we don't have all the answers. I mean, I started looking into CommonSpirit like 3 days ago.
Right.
And so I don't think we are trying to say we have all the answers. What we're trying to is kind of show people that want to invest in healthcare, or want to start something in healthcare, or want to understand how can add a health system. How can I engage with entrepreneurs? We want to show them, like, here's how we think about it. Here's how it could work. But I don't think we have an easy button. I don't think there is an easy button.
No, definitely not. So I think that's enough for this show. We will be back next week again in studio. I have no idea what we're going to talk about, but we'll figure it out.
But keep the comments coming in. I love the feedback. I love the people that like the show. I love the people that have constructive criticism. That's what gets us better. So, but all of it.
Yeah. And if you're listening, send Vic a congratulations note. He's hitting the milestone as a parent. His oldest is graduating from high school tomorrow.
Yes.
So
it's exciting.
Congratulations,
and kind of sad. My eldest is going to head off to college.
Yeah. It'll be sad for a little bit, but mostly exciting.
I'm proud of him.
Yeah. Mostly exciting. Anyway. All right, man. See you next week.
Okay.